Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about Cashflow hacking 2.0. Now, when I first started Cashflow hacking, I wrote my book, Cashflow Hacking, about 3.5 years ago, and it was an amazing time for me because it was the actualization of the philosophies that we've been living for a long time, and I wanted to be able to put it in an easily digestible book for people to be able to implement in their own lives and really understand the simplicity and the power behind investing for cash flow over accumulation, and realizing how much power and how much empowerment that puts in your life for you to be able to create the life that you want to live. And when I wrote that book, the idea was to save money in whole life insurance and then borrow against it, leverage it for the down payments of turnkey cash flow properties, and then compound the cash flow, compound the amount of properties that you have, keep funding your policy, use the cash flow from the property to pay the mortgage and also the policy loan. Make sure, and when you do that, the policy had, or the property had enough cash flow. It was a good filter to have enough cash flow to cover both of those. And when you did it effectively and you did it in the right markets, got the right properties, you had the right property management in place, then there was no other investment like it. Now, the challenge was, it was kind of a bummer for me because COVID happened, right? So right when I launched the book, COVID happens. And the challenge with that was the rental market just went bonkers, right? A lot of the projects, like I work with a guy named Mike Wolf. I just released a video with Mike Wolf talking about the power of turnkey real estate, and how to not be a landlord, but be a real estate investor. I just released that video last week. And the great part is the market's coming back around, right? Because the way that we do our stuff is we're able to find distressed properties. Mike Wolf goes out and he buys 30 to 80 properties at a time that have been in foreclosure. He then fixes them. He puts a warranty on them. He assigns a property management team to them. He gets a tenant in them. And then he sells the property as a cash flow producing asset immediately. So you, as the property owner, never have to deal with the downsides of being a landlord. You have a property manager that deals with everything. And the biggest risk of getting an initial tenant in there out of the gate is covered, right? And so that's the idea. Now, there's a lot more that goes into it. I'd suggest go back and watch that video. But today, I'm really excited because Cashflow hacking, I'm going to be launching Cashflow hacking, a second version of the book coming out this summer. And the reason I'm excited about that is because Cashflow hacking is expanding significantly. It's no longer just about whole life insurance and real estate. I have 5 pillars of Cashflow hacking that I call it now, and it's personal growth and expansion, debt management, savings optimization, investor DNA, and then tax and legacy planning. And so all 5 of those are part of the process, but I do want to take a minute because as part of your investor DNA, if being a real estate investor is in your investor DNA, well, that maybe you're interested in turnkey. It might be that you're interested in multifamily home syndications, fixing and flipping, whatever it is, tax deeds, some of these other real estate options out there, which we'll go into deeper, and we're going to dive much, much deeper in these topics as we go into other videos. But for this video, I want to go back to the original iteration of Cashflow hacking and show you the power that can be leveraged when you utilize whole life insurance, combining it with turnkey real estate. Now, if you go back and watch that video that I did with Mike, he's talking about investing in an area where you can get wildly cash flow producing houses that are costing between $150,000 and $200,000, and you need 25% down. So that means for anywhere between $37,500 and $50,000, you can have a down payment to buy a cash flow producing asset that is wildly profitable. Okay, so I use that example in today's video. What I wanted to do was show the power of saving in whole life insurance, leveraging that, putting it into turnkey real estate, and showing you the power of this strategy compared to any other strategy, compared to putting it in the S&P 500, compared to paying cash for the down payment, compared to pretty much anything else that you could compare it to. And in order to do this and do it effectively, I feel like I've broken a lot of stuff down and made it really simple in the examples that I'm going to give. And we're going to do a deep dive here to show you how to do it. What I did to start, I want to kind of give you the framework, is I started by doing a whole life illustration without any loans, okay? So the first thing I did was I ran a full illustration, funded, $200,000 front load. So I'm assuming somebody came in with some money because most real estate investors that we work with, this is a pretty standard policy that we do here. It's like about $200,000 up front for year one, and then about $24,000 to $40,000 a year thereafter, depending on who the individual is, right? This is a pretty common thing that we do. And so when we look at this, the first policy has $200,000 going in year one, $24,000 a year after that, and then from that point on, we never touch it. I just show accumulation. I show the policy, how it would potentially grow. I'll explain how it kind of works as we get into the policy, just so all the disclaimers are there. But then I did another illustration, and I showed in the other illustration, I showed loans coming out, and I showed the loans coming out in order to buy the properties. And then what I did is I'm going to break down the idea that whole life insurance is not about positive arbitrage. I'm going to show you some really cool stuff about the leverage of long-term thinking when it comes to having these policies in your financial life. And then finally, I did a full-blown Excel sheet where I go through and I show all the comparisons of all the different options and the different wealth potential of each strategy side by side. And so I think this is going to be almost impossible to ignore. And without further ado, let's just get into it.
All right. So you can see here, that's what I was talking about. So we got a $200,000 premium year one. So there's a $200,000 front load. And then you could see $4,000 a year. After that, I did put a 7-year term rider on this policy. And you can see every year after that, it goes down because the cost of term rider dropped off. So all you can put in is that $22,825. Now, one of the things I want to bring note to here, because I'm not a big fan of illustrations, because they always say illustrations are about as good as toilet paper once you have the policy in place. I think that's true with IUL. It's good with whole life. It's true with both of them. The difference is with whole life insurance, and this is important to understand, is that the non-guaranteed assumptions are based on two factors. The first factor, and I'll go down here and I'll write this out real quick because I think it's important to have a understanding of if you're going to do this. So dividends, for this policy to perform as we see it here, remember, because this current assumption right here is based on two factors. First and foremost, one, dividends will be paid every year. So we call it current assumptions, and it's based on these two factors. One, that dividends will be paid every year, which this company, by the way, has paid dividends every single year for 120 consecutive years. So to me, that is pretty comfortable current assumption. I'm going to assume that they're going to keep doing what they've always done since they've existed, right? And then the other thing we're going to do is we're going to assume that it's a current rate of 5.75 is what they are going to be paying. So what does that mean? Well, dividends fluctuate. They basically follow the fixed market. So if dividend rates go up, well, then these returns in this column could go up. If dividends go down, well, then these returns, this current assumption, could go down, right? The important part to understand about this 5.75 number is that we're near 80-year, 90-year level lows, right? So the lowest it's ever got to is 5.2%. And, that was just 2 years ago. So then it bumped up and it bumped up again this year, obviously because interest rates have increased. But to get to 5.2, it required being at the longest low interest rate environment that we've ever had, right? So really, really important to understand. So the other thing I want to talk about here is by the time this person gets to 76 years old, that internal rate of return on this policy is 4.4%, right? So when we do this, I'm going to go here for a second. At 76 years old, we could see there's $2,792,000, and it increased in net cash value. This is the first year we didn't have a premium, so that's why I focused on this number. The first year we didn't have a premium because the increase in net cash value was strictly from a combination of the dividend and the guaranteed growth. Remember, because the dividend, when you look at the dividend column here inside of the policy, the annual dividend is the current assumption of 5.75 minus the guarantee of 2%, so it's 3.75. That is what goes into the dividend. That is kind of what factors into the dividend. And the guarantee is going to be above and beyond that, right? That's how you get to the 4.4%. Now, of course, there's other things going on behind the scenes because 5.75 is a gross dividend crediting rate, and they are then going to back out the mortality experience, and whatever the mortality costs, expenses of the business, they're going to pull out of that. So that's where the 4.4 number comes from, is that it's going to grow at about that rate. Now, if you look at that compared to today's assumptions, that's pretty comparable with the bond alternative. And when you look at the tax advantages, when you look at the ancillary benefits, the life insurance, the living benefits, everything that goes with it, access to all that capital along the way, it really becomes a no-brainer when you see it. And I think I'm going to make that even more. Now, furthermore, one of the other things that I want to talk about here is the fact that this is a non-direct recognition company, right? And so what's important with this, and by the way, I'm not going to sit here and say that non-direct is better than direct. That's not the point of this video. But what I do like about non-direct recognition is that it's much more easy to understand and how the use of your policy is impacting the growth of the policy. So what I want you to focus on is down here, you have $2,979,000 of death benefit and $2,274,000 of cash value. And then when we get to age 76, again, we got $2,792,000 of cash value with about $3.45 million of debt. Okay, so just kind of keep these numbers in mind. We'll come back to them. I'll bounce back to them. But what's going to happen is I want to show you that by leveraging the money in your policy, one of the most powerful parts about having a whole life policy, you can leverage against it, you can borrow against it, use that money for other investments, whether it's business, private money lending, buying a single family home, turnkey real estate property like we're talking about now, which obviously is what we're going to focus on. But when you leverage it, when you borrow against it, you are not interrupting the growth of this. So whether you touch the money or leverage it, or whether you just let it grow, it doesn't impact this growth. That's the important thing to understand. Now, what does that look like? Well, let me see here. I want to see if I have, I'm just checking to make sure I'm in the right area here. So this is what I did. So then I took this same policy, okay? And I went through and I did $200,000, same exact design. You can see the first year, $187,000, 2.959 million. And then we went down here and $2,274,000. We've touched the loans. We've done all these different things where we've leveraged the policy multiple times. So I wanted to keep this kind of simple, but I also wanted to make it complex enough where it could show what's happening here. So what I did was, whenever I had the ability to, I took $100,000.
What's up, Cashflow hackers? I want to interrupt this video really quickly and let you know about something we have going on that's really exciting to me. It is our first major Life 180 event. It is the Life 180 Aligned Wealth Experience live in Scottsdale, Arizona, August 21st through August 23rd, where we are going to be changing the game in the life insurance space. So if you're an agent, if you're somebody who's looking to learn, kind of feel into, would this be good for you? Would these philosophies, these strategies be good for you? I'm going to be teaching. I've got other experts that are going to be coming in, teaching on the Rockefeller method, teaching on how to invest in real estate without being your own landlord, the highest level tax strategies, trust and estate planning strategies, all of these things, all the tools that the most successful people in the world utilize to get to where they want to go. This is what we're going to be covering in this. So it's going to be covering the whole cash flow hacking process. Have any questions, go in the link in the description below or go to life180.com/live2025. Check it out.
Via loan from the policy or against the policy, okay? So I took a loan against the policy. So what happens then? So I took a $100,000 loan. You could see the increase in that cash value is only 78,000 negative. That's because I still paid the premium over there. That's one of the reasons it doesn't show the full thing. And so now when we got the $100,000 loan, what is that able to do? Well, assuming that we're buying $200,000 houses, rental, that allows us to buy 2 properties. Okay. So you can see here year 1, or year 2 in the policy, we were able to do this. We picked up 2 houses. Then what we're doing is we're using the assumption that we're getting about an 8% cash flow on the loan that we're taking, this $100,000 loan. We're about 8% cash flow assumption on that. And that's all doable, by the way. We're going to get into that. And if you want to watch the video I did with Michael, go through that, you can see what I'm talking about. But we use the cash flow to recapitalize this loan. So we got those 2 houses year 2 there, but then we utilize this 8% cash flow. We pay back the policy loans, and we're still paying our premium, right? Because we're saving money actively. So the idea here is we have active income that we're paying this with, and we have our income coming from the properties that we're utilizing to pay back the policy loans. As we do both of those things, we're increasing our savings capacity. And you can see here about every 2 years, these little green boxes indicate when we have opportunities to buy 2 more houses at a flop, right? $50,000 a piece. Now, I'm not going to dispute this doesn't take into account inflation, the fact that rental properties will go up and so on and so forth. But I wanted to just share the principle of how this works to understand how the policies function behind the scenes to actually help you create more wealth with less risk. And that's the power of cash flow hacking. We always talk about the power of efficiency and increasing financial efficiency to reach our goals with less risk. And that's what this is all about. So you can see over this period of time, by year 15, we've been able to have 8 house buying instances, which picked up 16 houses. Okay. So this is really, really powerful. Now, when we get to the end here, you can see by the time we hit the end at age 76, we bought all those houses. Okay. So it's important to really understand that. And I'm going to go into the Excel sheet in a minute. That's going to give a really good, deep, detailed breakdown of the finances behind it all. But I want you to see this illustration, because when we get here, it's $2,792,059. Remember, we have tapped into this policy 8 different times in this example at $100,000 a pop to buy 16 houses. And when I do that, $2,792,2.792 million. That's exactly the number that we had when we didn't touch a policy. So that just goes to show you, when you borrow against your policy for things like real estate, you never interrupt the growth of your own money. It keeps going. It's really, really important to understand that. Now, I want to talk about one thing that a lot of people get confused. And that's the idea. There's this idea, and it drives me nuts, quite frankly. I got to say this, is that people like to talk about life insurance, about this idea of the positive arbitrage. I can't speak and write at the same time, apparently. So this idea of positive arbitrage. Okay, so positive arbitrage is an idea that I can borrow, let's just call it at 5%. This is what the whole conversation around internet banking has become online, even though that's not really what internet banking is about. Right? That's why I've kind of gotten away from it, and I've started really focusing on cash flow hacking to create more transparency about how this actually works. So the idea of positive arbitrage is that you borrow at 5% and you can earn, well, in this example, people would say you earn 5.75% with your dividend. Well, guess what? That's not the way it works, because as I explained earlier, the 5.75 is a dividend, but that's not what you're getting credited to your policy. You're going to be more in the 4.4% range over the long haul. Okay. So when we look at that, then it's like, okay, why would I borrow at 5% and only pay and only earn 4.4%? That's a good question. Most people think, well, that just makes no sense mathematically. I'm going to show you why that makes sense. But I also want to take this second. A lot of people talk about IUL and how it could be a better solution for this. And it cannot be a better solution, because a lot of times people say, well, you can borrow at 5% and I could earn up to a 10% cap. I never want to use IUL inside of my real estate investment portfolio. Anybody that tells you to do this, I'm gonna tell you right now, they don't do it for themselves, because either that or they maybe have done it for themselves for a couple of years and they've never experienced a really negative year or any negative years. Because what happens is you could do this, you can earn this potential spread, but the problem is on a negative year for the index, you're going to pick up a 5% cost because this 5% interest expense has to be paid either way. So on the years where you don't get this 10% crediting, the loans compound against you, and this 5% becomes an extra cost. And what we need for our real estate portfolio is consistency, predictability, measurability, things that we know are going to happen that we can control. And there are too many variables inside of this IUL equation that are out of our control, not just on the metrics of what we're doing inside of the cap rates and the loan rates and all that stuff, but all the other variables and metrics and levers that the life insurance company can manipulate and change against you in the long run. So really important to understand. And that's why, by the way, if you go down in the description below, I have my new book, IUL Exposed, that just got released. So you can go down there, check it out, get free copy, just pay for shipping and handling. I will send it to you if you are interested in learning about that. It will get into a lot of this stuff because it goes through IUL, full life, everything. Now, getting back to this topic, I wanted to do this example, and I ran some numbers, okay? In these numbers, we did a couple things. First and foremost, I said, all right, what if we were paying a 5.5% loan, but only earning 4% loan, okay, on our cash? What if we were paying 5.5 and only earning 4? Most people would say, well, that doesn't check out. Why would I borrow? I'd be better off paying cash. That's what most people would say. Well, they'd be wrong, because the power of life insurance here and the power of cash flow happen. Remember when I said in the previous screen, what are we doing? We're using this cash flow to pay back loans. So we always want to make sure we're servicing these loans. So the answer is, if you were never going to service your loans, the people who say that this is a bad deal are 100% right. But as long as you're willing to service your loans, which if you're doing this strategy and you're implementing and you're executing and you're cash flowing and you're being a good steward of your money, this is going to work out every time, 100% predictably. The only variable is your willingness and ability to execute and stay dedicated to it. Period. Okay. So what we look at here is the loan of 5.5%, the return at 4%. Year one, we obviously are in the negatives, right? Because we go, all right, $100,000. So what did I do here? I said $8,000 is going to go to paying this back. Okay. Why am I doing that? Well, I'm doing that. Why? I'm going to let you think for a second, but I'm doing that because we have 8% cash flow.
Are you either an agent or somebody who's looking to utilize Index Universal Life in your personal finances? Are you looking to try to educate people on how to sell them? Or are you looking to learn how Index Universal Life actually works? Well, I want to invite you to a special offer. I just launched this new book, IUL Exposed, the truth about the most misrepresented product in financial history. I got Garrett Gunderson who wrote the foreword to it. And here's the deal. This book is not just a hit piece. It's not a hate fest on Index Universal Life. What it is it's a full, transparent overview on how Index Universal Life works. It goes through the history. It goes through the history of all cash value life insurance, universal life insurance, whole life insurance, Index Universal Life, VUL, all the regulatory updates, and all of the elements that really go into how does Index Universal Life actually work. If you are looking to be the best agent in the industry doing what you do, I believe that you need to understand the nuances of how this works so you can actually show up and make sure you're serving your clients at your highest level. If you're somebody who's looking at buying an IUL or whole life policy, I believe the information in this book is going to be a game changer for you. It's 252 pages of straight magic. I know that sounds like a lot, but I promise you, I took everything that I had in my mind after 15 years in this business, being a former director of business development for one of the top IUL companies in the country, taking it all and ultimately exposing the myths and the untruths and misrepresentations about how it actually works. I tell you where it works, where the risks are, and ultimately how to utilize cash value life insurance to help you reach your ideal life. So hopefully you enjoy it. go down iulexposed.com, link in the description below, or just type in iulexposed.com and we'll see you over there.
On the 100,000, right? So what we're doing here is we had a $100,000 loan. We took that loan, we put it into real estate. We have an 8% cash flow on that money. So we're going to put that back into this loan. So we're going to pay down not just the interest, but a little bit of the principal. So if the interest, and I'm going to do this one time just to explain, is 5.5%, that equals 5,500, right? So 8,000 minus 5,500 is 2,500. And so 100,000, we're going to take 2,500 off the principal. 100,000 minus 2,500 is 97,500. Okay. And that's where we end up with this number right here. Next year, we start the year with a $97,500 loan balance. Okay. So I do that every single year. That's where this number, instead of putting the 8,000 that's going into it, every single year, it's assuming we're paying the $8,000 cash flow, which, by the way, is being really conservative, because if we're actually renting these out, that cash flow will get better and better and better, because as rental properties go up in value, your cash flow actually goes up, because rental prices, rental rates every 2 to 4 years will be increased. And so therefore these numbers will actually get better and better over time, right? So that's one of the most powerful elements of this. But once again, I'm just being wildly conservative and assuming that rental rates never go up. And we're just doing this same 8% the whole time. So now we have 97,500. Out of that, 5362 goes towards interest. And so we're able to take the spread, 8,000 minus 5362, and we're going to do that. And it goes down the next year. Our principal balance is 94,000, then 92, then 89, then 86. So we're paying the principal balance down on this one example, right? Just this $100,000 that we're focusing on principally. Because remember, the idea here is, why would I want to only get a 4% return and earn 5.5%? Well, I'm going to show you, because we're doing this for the long run, right? We're doing this over the long haul. The power of never interrupting the growth. Because I go from, oh, well, let me explain it like this. This is amortized debt, effectively, with simple interest, right? And so we're paying down this loan, and then we're compounding our money over here. Now, even if we only compounded a simple lower rate, 100,000 plus 4,000, 4% is 4,000, goes to 104 the next year. That year, we earn 4,160. It goes to 108,160. We got that kind of interest. Then it goes to 112. Then it goes to 116. Then it goes to 121. You can see by the time we hit year 6, we are now earning more interest over here than we're paying on the 5.5%, all with the same cash flow. Now, don't get me wrong, we're still in the negative on this side of the column, because we have 1, 2, 3, 4 years, 5 years of being behind. But from this point forward, year 6, this point on, we are going to have, let's say we did a 30-year process on this, from the time I'm 35 to the time I'm 65, and I want to retire 65 and have everything handled by then. Now I have 24 years where I'm operating in a positively leveraged scenario with no risk, with the only risk being my ability and willingness to execute, right? And like I said, it'll get better, because real estate will get better over time. Rental rates will go up. Your cash flow on older properties will get better and better and better every year. And this doesn't even include the tax benefits that you're going to get with property. So when you look at this, it really just becomes the biggest no-brainer in the world. So what I want to do now is I want to go to this page, and this shows exactly what I was talking about. I did a couple things here. You could see here 1, 2, 3, 4, 5, 6, 7, 8. And we did loan repayments of 8% of the total that was borrowed against, right? So then we did another 100,000, 8% total of the 200 total, right? So I was just doing that. I was using cash flow of the leverage, because that's what we're going to have for property value going into these. But so this cash flow that we're ultimately, the more we borrow, the more cash flow we're going to have from our rental properties, and that goes back to paying back the loans. What does that do? That recapitalizes it faster, because the cash flow is better. So as we pay back our loans, that money becomes liquefied, because you could see here the loan balance is going to continually go up because we're borrowing against it. Okay. But the bottom line is that as the loan balance goes up, our dividends, our cash flow, everything goes up, and we're able to recapitalize. And this is why back-to-back years here, you can buy more houses. Now, if you wanted to, you could keep doing more and more and more houses and keep growing if you wanted to. I just wanted to kind of stop and do it in a way that was easy to illustrate and easy to show the math for somebody who would wanted to be done and have all their houses paid by the time they're 70, to be able to live on the pure cash flow and have no debt, nothing going on, and just have pureness in the finances with no risk. Okay. And so now what we have here is we're going to go to the cash value and the policy. At 70 years old, the policy has grown to $2,035,000. Now, one of the things I want to do is go back here, and I want to go back to 70 years old, $2,035,000, $2,035,000. But you can see here the challenge with this example. 70 years old, $2,035,000. There we go. I was looking at the wrong year. $2,035,000 at 70 years old. Okay. So you can see that the policy has grown to that. The total cumulative premium, contract premium, cumulative premium right here on the $2,035,000 is $868,000. So it's more than double. It's like 2.5x over that period of time, over a 30-year period. For those who understand this game, you understand that that's not necessarily a sexy return, right? That's not a great return by any stretch. But what that is a safe return, right? That's going to be a bond alternative. And what this can do now for you is give you a lot of flexibility in retirement when it comes to understanding that this $2,035,000 would be a bond alternative. You could use it for a volatility buffer. You could use it as legacy planning. You could do a lot of different things with it because you get this extra death benefit. Now, the thing is, you can see here all the while you picked up these 16 homes during this 15-year period, right? But you still have policy loan outstanding right here. And so that's where we're using the cash flow from these loan repayments of $70,000 a year that we have going in that keeps stacking, getting better. What, for 8 to 16 to 24, 32, 40, 54, because we've bought a couple houses at the same time, and then 70. Right, so this 70,000, it goes and it pays these houses down. By the time we hit age 70, these houses will be the policy loans will be paid off. Right, at that time, you're going to have no more policy loan. You got the last payment of $55,270 at age 70, according to this illustration, and then you see you have this $2,035,000, but then you also have a property value of $6,179,000. Now, I don't know how they finance these, what the equity of the houses are, and what the mortgages are, so on and so forth. But we know that they're going to appreciate, and I only put appreciation assumptions just so everybody knows, 3% growth assumptions. So if you know anything about the real estate, you know that that's pretty conservative. And most people, when they do this, they do a 5% assumption. Because long-term, in these kinds of markets, real estate typically appreciates by about a 5% over the long run. I'm not saying it does it every year, but that's about what it comes out to. And so we're talking about 3%, trying to be really, really conservatively. 3%, it's I'm doing a 60% lower number than most people would put for assumptions on this to get to this $6 million property valuation. Now, at that point in time, you can continue to use this extra cash flow to accelerate whatever the rest of the mortgage pay downs that you would have if you want to do that. But right now, you got $6,179,000 of equity. That's the word I'm looking for. I'm thinking about 5 things at once. So you got $6,179,000 of equity, plus you got this death benefit. So you basically got over $8 million here. Okay. How much of your own money did you use to create this $8 million? And let's just say you only have like maybe $4 million of equity, right? Because let's just say you got a couple $1 million there. How much money did you use out of your own pocket to create that? Well, the answer is we have to just go back to where we were, right, at age 7 here. I gotta go back to here. At age 70, you used $868,000. If you use $868,000 of your own money, and it was able to get you to a place with $868,000 of your own money, and if you just looked at life insurance and said, well, I only 2.5x my money, well, then you wouldn't be seeing the whole picture, because you leveraged the strategy and implemented the principles that I talked about, and you understood the way the loans work. And it's not about arbitrage. It's about understanding, having a long-term view and thinking about this over a 30-year window, not just the next 6 years, right? Because if you look at this, you can see if I invested this money inside the S&P 500, and you could see here, I put $200,000, and I did a little equation over here just to kind of make it easy for you. If I want to put this in the S&P 500 at 8%, I've got 216 year one, right? I've got 259, got all these different things going on. Now, I've got all this property value, but remember, there's debt on this property value at the beginning. But the beautiful thing is our tenants are paying it down for us. We're getting tax benefits. We're getting all this stuff. But as more of this gets liquid, which absolutely happens later, the S&P 500 here, you're at 4,630,000. That may seem good, relatively speaking. And if you compare this to just the 2,035,000, obviously that's a no-brainer. But the fact is, when we go, say I bet your equity is about the equivalent of what your S&P 500 would be. And then you have, on top of that, you have the life insurance, you have the you have the living benefits, and you have the legacy play that will insulate whatever you have to do to pass this down to the next generation, if you have any estate tax issues or anything of that nature. Now, the other thing to think about here is we have this cash flow, and bare minimal, you're talking about having, $70,000 a year in free and clear cash flow. And that's $70,000 a year free and clear, so you've been using it to pay loans down in the policy. You can now take that and use it as income if you want to, or you can use it whatever you want. It doesn't really matter. You can use it to buy more properties, do whatever you want. At the end of the day, it's about creating options. And this is why I love this, because it's not about getting a tax deferral. It's about putting yourself in a position where you're creating real leverage with the least amount of risk possible, okay? Because what's happening is you're being able to invest a little bit, but you're creating leverage, and leverage is using other people's money. Well, who are we utilizing for other people's money in this? We're using the tenant. Why? Because the tenant is paying down mortgage, paying down the mortgage. When they're paying down the mortgage, what's that doing? That's increasing your equity, which is increasing your net worth, right? They're doing that. They're paying your interest on your mortgage for you too, so you're not picking up that expense. They're covering that for you, right? You're getting tax benefits, actual tax deductions, not tax deferrals like you get in a qualified plan, right? So you get to depreciate the properties while they're appreciating in value. And the power of that doesn't even come into this equation that I'm talking about. So what I really want people to understand is the fact that when you compare this idea of cash flow hacking, and by the way, this principle, we're doing this and we're focusing on real estate because I think it's a really easy thing to look at, the metrics and to understand it. And I think a lot of people are interested in real estate. And if you are somebody who isn't the most savvy person in the world, when it comes to business, I know if everybody can do this real estate game in this way, the way that we teach it. And it's just a matter of you have to have the right resources. And that's why, we partnered up with Mike Wolf to be able to have him share his systems with you the way he shared it with us. And so what I want to share is that it doesn't matter. It could be what I'm showing you here with real estate, but guess what? The principles that I'm talking about here work in your business. They can work with private money lending. They can work in this kind of real estate. They can work in any situation where you're able to have a long-term view, which I think is important that everybody does.
So I hope that made sense. If you have any questions, I think this kind of lays it out clearly. But once again, cash flow hacking is about more than this. But I kind of wanted to go back to the roots. I wanted to be able to share the power of whole life insurance and real estate in combination with each other, because I think it's something that most people just miss the ball on. And the people that get excited about it, a lot of times it gets misinterpreted or explained by life insurance agents when they talk about the positive arbitrage and the spread and all these things when it comes to whole life insurance, acting like there's something to be gained there. I understand that a lot of people are saying that because they're trying to simplify it, but the bottom line is I believe words matter, and arbitrage is not what's happening. You're creating a safe leverage and you're earning compound interest while you're paying amortized debt, and at some point in time there's this crossover where the compounding benefits more, and when you have a long enough term horizon, you always win. That's what it comes down to. And so as real estate investors, as investors who want to be thinking about things from an intergenerational perspective, I think this is how we always have to look at it. And this is why I always say people struggle with their money because their money is not in alignment with their values and beliefs. And if you care about more than you, if you care about your family, if you care about the next generation, if you care about being able to build something for yourself now and being able to do something for your future generations, this is the way to do it, right? I feel like that's one of the challenging elements in people's lives that they have, is they always feel like they got to sacrifice their future for themselves. They got to do, they're entrepreneurs. The plight of the entrepreneur is like, do I take care of my business or do I focus on retirement? And it's like, I always got to pull from one at the expense of the other. And the reality is, based on what I'm showing you here, that's not the case at all. You can have your cake and eat it too. And so if you have any questions, comment in the comment section below. Tell me what you think the biggest takeaway is from this video for you. I'd be really, really curious to know. The comments absolutely are the best way to help us grow this channel. So anything you can do to engage, share, comment, like, get this out there, subscribe, hit the bell. That way you're notified every time we launch a new video. Really excited to have you here. Have a blessed, inspirational day. We'll talk soon. Later.